Welcome everybody back to our webinar series, Developing Superb Trading Strategies. My name, Stefan Friedrichowski, as always, for those kind of webinars. Yeah, thanks to ArgusFX, I have to mention, because they make the webinar series possible. That's very good, because so we can keep in touch with each other and talk about developing of trading strategies. As always, on Thursday, today is the 2nd of March 2017. And yeah, after 1 week pause, so last week there has been no webinar, but now we are back to regular schedule, so everything is all right. I have to mention, as always, for those kind of webinars, the so-called risk warning. So whenever you do your trading, of course, I give you some ideas here, but finally you do everything on your own. But that is, I think, quite obvious, and you know that quite well. Yeah, today is a new strategy day, or let's say in two parts. So what will be the topics of today? First, as always, questions and answers from last week. There's not much to report. There's one question I can answer directly. So that's not very difficult. But next main topic is what I call the reverse trading. That is a little bit triggered from questions I got or observations I have made concerning, for example, social trading. So whenever you have those kind of social trading platforms, a few of them, they offer, most of them, they offer what they call reverse trading. So the idea is, look to an account, see, oh, that account is not behaving quite well. So what I would like to do is simply, I follow that account, but I reverse those trades. So sounds good, because then this may be going south equity curve should, question mark, be transferred into a positive equity line. I can tell you right away, the answer is no, that does not work. But it is a good thing to look into that a little bit more in detail. Not because I like the idea of reverse trading, but you will see that if we investigate a little bit more in detail what we can do around that basic idea, then it is quite interesting to derive some general rules for trading or just some observations. So what I want to share today with you is that I show you a small framework just to have a real heavy trading activity by simulation, and I will do it here online. So we will, let's call it, back test some principal ideas, and we do it with a huge number of data. So I will use M5 data for euro, US dollar for the last 13 years, which is more than 1 million of candles. So, but nevertheless, due to the C programs I coded by myself, it's quite fast. So already in about 10 seconds, we get equity lines for those data, which is quite impressive for itself. But so then we have the opportunity to directly investigate what does it mean with reverse trading, what does it mean having risk-reward ratios of 1, of 2, of 10, of 0.5. So we can do it here right away online, and whenever you think, hey, you have some ideas of some parameters, I can use those as well here directly and online. The other topic for today is simply triggered by Peter Müllner because he has set up an expert advisor now for what we discussed a couple of months ago. I think it was in October. I have later on my slide the exact date. We discussed a strategy called seasonal DAX week of day trading. So what we use there, we use the statistical information of the last, I don't know exactly, but about 20 years or 15 years of typical behaviors of typical days of the week. So day of the week means difference between Monday, Tuesday, Wednesday, and so on. And the observation has been that there are days with typical sign, so sign of the movement, related to the overall situation of the market, and the overall situation of the market was described by a simple EMA. And since now that expert advisor is ready and we can go on with that strategy in real accounts, and we don't have to do it finally anymore in Excel and do any trades manual. So therefore, it's time to update our Excel sheet of what we have done a couple of months ago, and then see, hey, do we need maybe minor changes of our parameters, and so we can set up the final rules for exactly that strategy, and still you have the opportunity to simply to use, for example, that Excel sheet and go on with that strategy, or yeah, we will set up an expert advisor on a real account, and then there's always the opportunity to follow something like that. Good. So that for the introduction, let's go into the topic directly. So there was one question on that slide, is still nothing to report, but there was one that was related to what we discussed 2 weeks ago, that was all around swap costs, and the question was simply, hey, can you show the account once again? Because that is an account which I showed already in last webinar, and the idea was here simply that on the 4th of January, so it's now 2 months ago, I have opened a couple of trades simply by looking, hey, do I get swap profits or swap costs? And I opened a couple of trades, all of them just with 0.01 lot, and I selected lots of those one who have positive swap values, and the trade itself doesn't have any stop loss. So just idea was, hey, maybe it's good to open a trade into the direction of positive swap values. So that's all. So it's really quite simple, basic idea. And what you see here right now is that most of those trades with the comment swap, they are positive. They are, or let's say the other way around. There are few which have positive results by trading itself. So just looking to the profit of that trade. There are a few ones which have negative results. We see, of course, the accumulated swap values, and you see that now it's maybe a good time to close one trade because the sign of swap costs for Australian dollar, US dollar has changed, so now we get a little bit of costs here. So it may be a good time to close a trade, and I will do it right away. But still, what we see here is that in total, and even if there are some additional trades open out of other strategies, you see a total profit which is not that bad, and yeah. So still it's running well. even the complete combination of all those trades. And if you are still a little bit more interested in swap trading and all the ideas around that, and there have been some more ideas I presented last webinar, so 2 weeks ago, you can simply look once again to here to the YouTube channel, and you may even download my slides here as you find them in your GoToWebinar control panel, so you can download the slides of today directly here, and then you have that complicated link to the YouTube channel all around swap trading. Okay, so still, I think it's not a real statistic, just looking to those trades, but nevertheless, up to now, it behaves quite well. So the idea to open trades into the direction of positive swap values, which, for example, means for British pound, New Zealand dollar, that is a short trade, maybe it's not a bad idea. Still, we have to look into that much more in detail, and then we can really go on with that strategy, even historical driven, but there I still need some data. I don't have them up to now because I would need those historical swap prices or swap costs for at least a couple of years, and then I could investigate its strategy, more complete and really statistically. Good. Anyhow, so back to what is called reverse trading on those social trading platforms, which are more and more quite popular nowadays, and there are a lot of even brokers offering those opportunities. And sometimes you find what they call reverse trading. The idea is, as mentioned already, trades are mirrored. So what does it mean? So if there's a short trade opened in the leader's account, then normally you would open a short trade in your own account as well. But now, simple idea, because maybe the performance of that leader is not that good, just mirror those trades. So what does it mean? That would mean an original short trade will be in your account long trade and vice versa. I mentioned here already that this idea, I know for sure that it doesn't work, and the quite straightforward answer to the questions is really simple, and it's more driven by my general thinking, more from the physical standpoint or mathematical driven. The fundamental reason that this is not a good idea is trading is not symmetric. That sounds a little bit complicated, but so what does it mean if I say trading is not symmetric? Trading is not symmetric because of a simple reason. There's an element of asymmetry in trading, and that is simply the spreads. So since the spreads are always working against you, so that is, for example, one reason why trading is not symmetric. And the other reason is symmetrical trades would only be trades with a risk-reward ratio of 1. In case you have a risk-reward ratio not equal 1, then by itself all the trades are not symmetric. So you know that, for example, if you open a long trade on euro US dollar, you set a stop loss some distance below, and anybody else, and you would, for example, trade with a risk-reward ratio of 3. If your trade is hitting the stop loss, it does not mean that the reverse trade would be reaching his or its take profit anymore. So looking to that in a little bit more detail, I will go on the next slide and then introduce everything a little bit more in detail. But let's first go through the list of how I will really here online create equity curves with my C-coded or C programs. And the basis here is Euro, US dollar based on M5 candles. And I mentioned already, hey, that's really a huge number of data. That's nearly 1 million candles we investigate. In principle, we could open, let's say, a trade every 5 minutes. I will not do that. I will explain a little bit later, but let's go through the list of how those trades are managed, so to say. So I don't want to have endless trades, even not looking to swap costs today, but I don't want to have them endless, and therefore I simply fixed the maximum duration of a trade just for 1 week. That is just a number. I could change that, but it would not change any outcome or any conclusion here. So then what I do here, because I enter really a lot of trades, I need a stop loss for those trades. And that stop loss, because I strongly believe that taking into account ATR for stop loss values is in principle a good idea because, you know, market volatility changes over time. Sometimes we have extremely high volatility and sometimes quite low volatility. So therefore it's good to relate that stop loss, for example, not percentage based or fixed like 20 bips or something like that. No, I will relate them as a multiple of ATRs. So also changing that to fixed bips or would not change the overall picture, definitely. So we can change that stop loss multiplier later. And what we have else is a variable CRV, or in English it's better called risk-reward ratio. So the multiple between take profit and stop loss. So I mentioned in principle we could open every 5 minutes one trade. Since then the number would be 1 million trades for that period of time. I reduce that a little bit by a simple rule. And that simple rule is based on the price itself and based on the ATR. What I mean here is if I open a trade now and that trade will go on. After 5 minutes, I look once again, should I open a new trade? And I would answer that question only with yes, if the price itself has changed enough. And that enough is once again based on a multiple of ATR. So what does it mean? If we have a situation that the price changes dramatically over time, then we would open very often trades. But if, for example, during night, that is a typical example, if the price does not change really, then I open one trade and then I will wait until the price has changed enough. That is only to reduce the number of trades. It has nothing really to do with any conclusions we can derive here. And what I do always, I simply calculate one equity curve for all short trades, one for all long trades, and one for the sum of both. So that would mean I open a long and a short trade always simultaneously. So those are the rules to get those equity lines, and there are really some quite interesting results. Honestly, when I today prepared those slides, and I have done the analysis during the last couple of days and weeks, but today, when I made my slides here for that webinar, there was one idea or something popping up in my mind, and that is that in principle there are two variants of that type of mirroring or entering long and short trades. You will see I do it always simultaneously because I want to have both and want to see the result of both. But in principle, there are two fundamental types of mirroring approach. One is only mirror the trade direction. What do I mean here? That means a long trade will convert it to a short trade, and the short trade will be converted to a long trade. But now the question is, what about stop loss and take profit? And now we have two opportunities. One is that we say, what is the stop loss for the one trade will be the take profit for the mirrored trade, and vice versa. So think about you have a risk-reward ratio of 3, and the original trade would have a stop loss. Think about a long trade, 1% below entry. That would mean with the risk-reward ratio of 3, your take profit would be 3% above your entry. Good. The mirrored trade, according to the variant 1, would be a short trade, yes. But now the stop loss is the take profit of the original trade. So that would mean we automatically translate that trade to a trade with the stop loss being much far away than the original one, and the take profit would be, let's say, quite tight. So finally, it would be a trade with a risk-reward ratio of 0.33. Okay, so that's one possibility to look for those mirrored trade. The other one is that we even mirror stop loss and take profit. So what does it mean? We mirror, of course, the trade direction, yes. And if the stop loss for the original trade has been 1% below for that long trade, then for our short trade, we apply now the same stop loss distance. So we keep for that trade the risk-reward ratio, for example, to 3. So there are two, let's call it, fundamental types of how to mirror a trade. You can build for sure a lot of other types, but those two fundamental types represent how to mirror trades. And what I will do now is I will only look first to the variant 2. So that means I open two trades always, a long and a short trade, and both trades have the same risk-reward ratio. So stop loss, for example, is maybe 2 times ATR, and that is now for both trades. And if the risk-reward ratio is 3, okay, once again, a factor of 3 for the take profit on both trades, for the long and for the short trade. So that's all. To illustrate that a little bit more in detail, let's have a look to a chart more here live, and let's simulate a little bit what I mean here. So I do everything on M5 base. So for example, if I now look for a trade entering here, so let's say this line would be the open of a trade. And by the way, in the back testing or the simulation we will do in a minute, we always open that trade to the open of a candle. So now let's think we would open a trade at that green line. And the long trade gets a stop loss, for example, like here. And maybe I change now color for that trade or for that stop loss, and that stop loss gets this red line. So we have that distance for stop loss, and if we apply a risk-reward ratio of 2, then the take profit for that trade would be about that red line. So that's the one trade. But now to the other trade, because we always look for a long trade and a short trade simultaneously. So the open price would be once again the green line here. But now we have the two variants of mirroring. One, if now that would be the entry for the short trade, variant 1 is, okay, stop loss is that red line, take profit is now the lower red line. Finally, that would mean from risk-reward ratio 2 to 1, we get now 1 to 2. So that is variant 1. Variant 2 of that mirroring is now, okay, we take the same distance from the long trade on the short direction, which is about here. And let me change color once again. So we would have, for example, the stop loss for that short trade directly here, same distance as the long trade, and take profit would be around here. So once again, 2 times stop loss. That is variant 2. And that is the one we go further here now in detail, looking what happens with equities if you simply follow that kind of rules. I think everything will you will understand a little bit more when I now really do that kind of simulation. So let me just show you when I start here my simulation. I have as an input the data file, so the prices, the candles, those about 12 years M5 candles. And then I have the opportunity here to enter a spread, which is now right now 0, because we start with spreads of 0. Then I can enter swap costs and I can enter a commission value, but for now I will have those numbers always to 0. The next part here is simply where to store the results, but anyhow. And now I have here 3 values. And those 3 values are, first one, the 30, when that will be the start value. This 30 is the stop loss multiplier for that ATR. So we start with a very far away stop loss. So that is just the multiplier on the ATR for setting up the stop loss of all trades. Next number is the risk-reward ratio, which is right now simply 1. And the last number is that mentioned pause. So how often do we trade? And I wait, if I have opened a trade, I will only open trade until the price has changed more than 5 times ATR. So that is what we can change here. But believe me, what we do here is only changing ATR multipliers. We will change risk-reward ratios, and we will enter spread values here as well. So now calculation, let's do everything visual. And what do I mean? Let's have a look to the equity. That is the equity over those last 12 years for the sum of both trades, so long trades and short trades. And by the way, the x-axis here it's a date, but it's the date in seconds since, I don't know. But anyhow, so that represents 12 years. And not surprisingly, what do we have? Our equity is more or less a straight line. That we have sometimes +1 and sometimes -1 is simply we calculate everything in R. And yeah, what does it mean here? Here it means that all trades, because we have a risk-reward ratio of 1, and that all trades, if the short trade reaches a stop loss, the long trade reaches take profit. Therefore, nothing happens with our equity. Let me draw in the equity of all short and long trades. Let me draw the chart for the long trades only. That's that green line now. So that green line has only the long trades. And what we see here, okay, equity goes up and up and up, and then finally goes down. Good. Let me later show you the price of euro, US dollar for the last 12 years. Then you will clearly understand why it first works not that bad with long trades, and so long trades only, and especially within that period we go deeply down, and that's because the euro, US dollar more or less went to the south. So that is the results of all long trades. And now let's have a look to all short trades as well. And what's not surprisingly now, the two lines, the green and blue line, are exactly symmetric. That's not a surprise. Why? We don't have spreads, we don't have swap costs, no commissions. We have a risk-reward ratio of 1. So, of course, now all the trades must be symmetric. And that's exactly showing in the single equity curve for all long trades and the single equity curve for all short trades. And the sum is the known red one. And of course, no surprise. Let me first now show you something which has a little bit more to do with the kind of how I do the simulations. Now I will change, and I will change that not risk reward ratio, the stop loss distance only to 10 times ATR. So stop losses become a little bit more tight. And let me start that calculation, and let me still draw the line for the one we know already. So that is the one for stop losses quite far away, 30 times ATR. And now let me plot within the same plot the results for a more tight stop loss setting. And now you see something strange. Why? Still, the expectation would have been that for the green line, that still the equity should be more or less 0. Why is the equity here not 0? Simple answer. That has to do with the way how I investigate reaching stop loss and take profit. Since I don't use tick data, because I use candle data, and additionally I have always that worst case scenario. If I have a trade And now think about a huge M5 candle coming up. Then in principle, I don't know whether the stop loss has reached first or second. So stop loss and then take profit, or take profit and then stop loss. I don't know, and I don't have an answer, simply because I use candlestick data and not tick data. I know, just from mathematical reasons, in principle, it should be the zero line once again. But you see, sometimes we have those situations, and therefore we go a little bit south here for that equity curve. That is even more pronounced if I once again go down with my values of ATR, so the stop loss distance for all our trades, and let me draw that line as well within the same chart, and that's now this one. And as expected, that case, that my worst case scenario, that I always think stop loss first, is a little bit more often. So therefore, that line even goes more to the south. Okay, and we know the reason, and we know that this is a little bit wrong, but only due to the implementation, not knowing what comes first, stop loss or take profit. We know for sure that for risk-reward ratio of 1, in principle, everything has to be symmetric. For the last one, once again, I want to plot the long and short separately. And oops, sorry, that's wrong. Was just 1 second. There's missing a replot, and now I put in all the long trades and all the short trades. Okay, once again, we see that symmetric behavior. There is a little bit asymmetry because you can't see it by your eyes, but we know that from the red curve. So it goes south. Back to the question, hey, is there something good about reverse trading? So we now know exactly the results in this situation. And ideally, the red line would be still 0, and we know the reason why not. And we have all the short trades and all the long trades. But now, let's do something. Let's now give a spread value within the calculation. And the spread I use now is only 0.8 bips, which is not that much. That is a typical spread for a broker not having commissions, and it's already the good case scenario, because you will have always that 0.8 bips being the spread value. Let's do the calculation once again. And let's start with looking to the results. First, we look to the old values. You remember that is risk-reward ratio 1 without any spread, a little bit going south due to that not knowing what comes first, stop loss and take profit. And now let's plot within the same graph the values for with spread. Let me check the number of zeros. Yeah. There's something wrong. 4 zeros. Okay. Don't see the reason. Just a second. What's wrong here? Okay. Sorry for that delay. And now we have the result. Wow. So now we have reverse trading. We do always the same trades, and the sum of both equity curves is going down to minus 800 Rs. Wow. Simply the reason is the asymmetry. So because having those spreads, we have that extremely bad result. So the spread itself ruins any mirroring. Why can I still say that? So we know that for a risk-reward ratio of 1, in principle, everything should be symmetric. But just by entering the spread, or by taking into account the spread, it goes south extremely. By the way, the number of trades here is 25,000, so it's really a lot of trades. And you see the result. But now the good news. Let's go back to what we have done first. Let's ask ourselves the question, what if? Let's go back to without spreads. And let's go back to that equity curve or long trades, the sum of long and short trades. But now let's do something strange. Not really strange, but let's follow an idea. Maybe, what about if we change a risk-reward ratio to 1.5? What does it mean? Now, by itself, the trades are not symmetric because they have different stop loss and take profit distance. Let's calculate the equity for, once again, for all long, for all short, and the sum of both trades here again, and plot that result in the same graph. So we have now a risk-reward ratio of 1.5, and we can look to the results. Oh, sorry, we forgot the one before, and now let's do a replot, and now we, sorry. I need to see here everything. Risk-reward ratio 1, that's the one we start with, and now the other one, risk-reward ratio 1.5. Good. Interesting result. So what did we change now? We changed risk-reward ratio, and we know, because we broke now the symmetry, we get a slightly positive result for our equity. That's really interesting that now it works already a little bit. Let me double risk-reward ratio to 3. And let's do the calculation once again. And plot those results within the same graph. Oh, that was not ready. Now we have it. Not that bad. So going to a risk-reward ratio of 3 makes us already profitable. And by the way, that is something, if you follow me and all my trading activities, you will realize in most cases we have strategies with risk-reward ratios bigger than 1. The reason that we now are positive is really a little bit more sophisticated, because it's not obvious that it should be positive. If the underlying, in our case, a euro-US dollar, would be purely random, then just by changing risk-reward ratios, would not change the result. It should still be a flat line if it's purely random. So what we do have here indirectly is a hint, I don't want to call it proof, that the price movement is not purely random what we have. Let me repeat a little bit what we do here. We don't have spreads up to now. Okay, we will enter spreads in a minute. We open always a short and a long trade simultaneously, and we use a risk-reward ratio of bigger than 1. And the sum of all trades, long and short, is now the blue line, which is not that bad. I mean, having that in my account is really not that bad. So the good news is, hey, there is something we can look for. And the second news is, if the price would be purely random, then we would find positive results here. It should be a flat line. Let me change a little bit more risk-reward ratio, and then I'll go, let's say, for a risk-reward ratio of 10. And now we can translate a little bit that kind of strategy already in a trading activity. It would mean, okay, we open always short and long trade. Good. You can put a question mark whether that is good or not. I know. But now we have a risk-reward ratio of 10 for all the trades. That means, okay, most probably a lot of trades will be reaching stop loss. So win rate would be quite low. But if the other trade, if one trade reaches a stop loss, the other trade is still alive. And if now the price moves dramatically into that direction, then we get a profit. And then we get a final profit as a sum out of that long and short trade. So I promised to plot that here as well. And now it's not getting better, so to say. So the result for extremely high risk-reward ratio is not that good. You see extremely volatile equity line here, but looking, well, which one, the blue or the pink, would I like to have in my account, then the blue one would be better. So there's another one, and that is a risk-reward ratio of 2, and that is the one I found out is really not that bad. And let me plot that as well. So let me wait a second until I have those numbers, and you see, okay, that's now risk-reward ratio 2. That is that line. Yeah, it is questionable which one is better, the blue or the other blue line. I don't know the English word for the color, turquoise. I don't know. Anyhow, the maximum drawdown of the turquoise one would be a little bit lower than the blue one. So let's concentrate on that one first and investigate a little bit more what happens here. So you have now the here the sum of all long and short trades for risk-reward ratio 2. And by the way, it's 25,000 trades. And now let's have a look on the individual side. So here are all long trades, and here are all short trades. And of course, in principle, the long trades are better than the short trades, which is not surprisingly because euro US dollar in total, or for the longer time, it has been in an upwards trend, but then there was a sharp going down, and that's the reason why at that point in time the short direction is the preferred one and makes more profit. But still we see that finally the sum of all short and long trades, all trades are entered with a risk-reward ratio of 2, and stop loss is 5 times ATR. Good. Sounds like a strategy, but going back to the pure sum, and that's this one here. But now, what's about spreads? Still, we do everything without any spread. So let us introduce the spread once again here. And introducing the spread is quite easy for me here. So 0.8 bips once again here. And now let's do the drawing here as well. And that means I need an 8 here as well. So, and equity looks like this. Okay, I wait a second that you can digest that result. So originally, there was already quite good equity, the red line. So quite good equity for all the long and all short trades. But now I have taken into account the spread values as well. And you see what happens. The strategy is ruined. So there is finally a negative slope within that equity. So back to the question, can we expect something out of mirroring trades? So at least what we know now from those kind of analysis, and be sure that I have done much more than I showed here in the webinar, looking around different values of ATRs, ATR multipliers, and so on. It does not turn out that there's anything possible getting a positive, a good positive result. There are some strange values, you get a slightly positive result, but I don't think they are really meaningful. We see what is expected. The spread is entering an not symmetric element into trading, and therefore even going always both directions doesn't really help. Why can I say that still? Because I look always here to the sum of all trades. So what I would like to see is that one would be positive and the other one negative, and I don't see something like that. So that is an indirect proof that that kind of mirroring does not work well. And you can get lots of numbers and still don't have good results. We have not done the analysis for the other type of mirroring. The other type would be that the one trade is opened with a risk reward with, for example, 2, and the mirrored or the reversed one would be opened with a risk reward ratio of 0.5. So that is still under or should be investigated. I have not done that analysis up to now. I will do it, and I will present the results next week. But now back to that equity line here. Looking to the green with that sum of all short and long trades is still, for me, let's call it interesting. Because we have periods where even with spreads, we have positive slope in that kind of equity. So you might think, okay, two things you might think. One is why opening a long and a short trade simultaneously. And you're right. In principle, doing that, you can build up a range and opening trades only when that range is left. That would be the better implementation of that kind of strategy. That would reduce already spread costs. But anyhow, it means if we now figure out, let's call it an indicator, something which pops up and says, wow, not that bad. We can follow that kind of strategy in specific periods. So if we now find the filter, filtering out exactly those behaviors with a very, in some have positive results, then of course we would have a quite well working strategy. So maybe it's only a question of a right filter. Right now we do 25,810 trades. Maybe we can find a filter, reducing that number, I don't know to what number, but having more those trades which are in some positive. So that's another thing we can take out of that investigation, because we know there exist those kind of periods, which is already quite interesting. Other result, I just want to repeat myself here, that we have, without spread, without that asymmetric element, that we have a positive result for the sum of short and long trades without taking spreads into account, is a hint that price movements for forex markets, or in this case euro US dollar, are not completely random. Please think about that sentence, and maybe you can write me a comment whether you would agree or not. But my expectation is that if a price would be purely random, then having risk-reward ratios of 2, of 10, of whatever number cannot change the result that finally the equity curve should be 0 and nothing else for a purely random behavior. So, but for me, it's a very good hint that this is a violation of randomness for prices, which is indeed good news, because we need that. Random behavior cannot be overcome, cannot be beaten by anything, and therefore that is, by the way, very good news. Wow, now I realize, oh sorry, that we talk a lot about already 1 hour here about reverse trading and investigating long and short trades and the sum of all and so on. We got some very nice conclusions, I think. I hope you agree. And maybe you can write me some comments on your thoughts as well. It would be a pleasure for me to get in touch with you about that topic as well. So the other one, the week of day, updating the parameters, should be postponed to next week. I have done the work, so but I want to show you a little bit the how-to. And therefore that will be postponed to next week. So next week we will have that, and the other one will be now shorter, the variant 1 for that mirroring of trades. Yeah, I hope you enjoyed that kind of webinar. It was a little bit more theoretically here today, but it gives us insights into the markets, and that will be quite helpful for developing trading strategies. So for all of you, have a good day, and hopefully see you again next week, same time, same place. Have a good time. Bye bye.